Good day, everybody. This is Jim Kenny for the Option Professor Weekly Market Update. Of course, today is the 9th of November, 2018. To introduce myself, I am Jim Kenny, and I do provide the content for Option Professor and give you an update each and every week. I've been in this industry for over 30 years in the investment world, and I'm a graduate of Boston College. I'm going to try to give you my opinions and my views like I do every week at this time. For those of you who have been tuning in regularly, you are probably aware that as far as the S&P is concerned, I was looking for the lows down at 2,600 to hold, and basically looking for a rally out of there, which is what we've got, and it's a very strong rally this week. Those who talked to me after the Wednesday rally did know that I did instruct them that Thursdays are sometimes reversal days, and the market had come a long way in a short time, and the likelihood for it to roll over a bit was certainly in the cards, and that's exactly what we saw yesterday and today. Now, as always, I do say that past performance is not necessarily indicative of future results. Remember that. And also that the short-term trading strategies and options do involve substantial risk and are not right for everybody. So do consult your financial advisors and your clearing firms on the suitability of any of the activities that go on out here. Okay, getting right into it here on the S&P 500. Again, we had a big sell-off in the month of October. And again, the things that did drive the market down, which is slower global growth, a hiking interest rate environment which competes for capital, and other factors like the trade tariffs have not gone away. So what is going to help us figure out what's going to happen between now and year end? Well, a couple of things could come into play. Seasonally, November starts the beginning of a very good phase in the stock market. And also, the buybacks are supposed to be very pronounced here in the month of November. In fact, some people are calling for record buybacks in the month of November. Remember, buybacks go into a blackout period at the end of each quarter and until all the earnings are announced, obviously, so not conflicting with reporting of earnings. And now that cloud has been lifted a bit, as well as the midterm elections. Don't forget, after midterm elections, historically, the stock market has also performed quite well. So there's a lot of tailwind coming that way, trying to offset some of the headwinds. And as long as we hold 2,600 on the S&P, I think that there is still a possibility for further up move. That doesn't mean you can just throw caution to the wind. I think it's something that where you're going to have to focus in certain sectors. If we are going to see a move to the upside, some people do believe that people will return back into the growth area, such as Microsoft, Apple, Google, and Amazon. Now, we saw very big moves on those to the upside this week. We also saw very big moves to the downside. Those of you who have been listening to the broadcast when we saw Amazon up at 2050, I brought to your attention that Amazon was $500 approximately above its 200-day moving average, and the likelihood that that move above 2,000 in Amazon was unsustainable was quite high. Obviously, that was very accurate, and the market pulled back not only to the 200-day average, but went through it. Now we're back on the bicycle to the upside a little bit on Amazon. Let's pull that up a little bit so you can get a look. And as far as the S&P is concerned, again, today you can see it's on the defensive, and Amazon's also on the defensive after a very strong rally. I mean, let's be frank. It went all the way down from 2050 all the way down underneath 1,500. The moving average when I was talking about it was around 1,550. So it went right through that. But look at it now. It's gone up, about $300 a share. So it is very volatile. Again, there is still plenty of resistance right now, I would believe, around 1,900. So my view going into the end of the year is that it's either going to have a very strong move to the upside, or B, it's going to go into a trading range. I think those are the two most likely scenarios for most of the stocks as we go into the end of the year. Again, we do have a very big meeting with the G20 at the end of the month. I think that's going to be very important to have some type of a positive vibe. But of course, the election that occurred on Tuesday did balance out the power a little bit as far as checks and balances. And so passing tax laws at 4 o'clock in the morning or whatever they did with that first tax agreement, where some people I don't even think read the agreement and they were voting on it. That's what I had read anyway. I don't think that's going to happen quite as much. So things might slow down as far as all the massive changes that were going on. Also, there could be a change in the tax situation as far as the 40% tax cut to corporations. They may have to give some of that back. Could be a little clawback there and shift some of that over to the more highly population that doesn't make $1 million a year. So in other words, transferring some of that tax cut over to the general population with a 10% maybe tax cut for the general population, and keeping the higher end people and the corporations maybe at around 30%. That's being talked about. Wouldn't shock me if they did moderate that a little bit. With regards to some of the other stocks here that I just mentioned, Microsoft had a very big move. So there are those who believe that if we're going to get a move out of here to a new high, or at least test the highs, that stocks like Microsoft, which were up very big last week, Amazon, which I just showed you. Let's take a look here at Google, and we'll see what Google looks like real quick. Here, Google. And Google, again, had a big move yesterday, and today it's down. Oh, a lot of the things that went way up are having a pullback now. Again, your line in the sand, if you're using the indexes, in my view, is 2,600. Underneath that, the 52-week lows at around 25.20 would be probably the thing you'd have to start looking at after that. But again, with the buybacks coming in this month, you would think that there's a good bid underneath the market. So, again, I think the long side until we take out 2,600 has got to be the view, in my view, based on a lot of things, including the seasonality and the buybacks coming in. With regards to the semiconductors, that's another one people are talking about, and they're looking at Intel as a proxy for that. And basically, Intel today is only down about 50 cents or so, and it's coming off 42, which is the 52-week low. And if we put the graph up there where you can see it better, there seems to be some gap activity above 50. So maybe going up, 5 or 10%, and that is not off the cards either. So there you go. Intel is starting to improve as well. Again, if we're going to have a big move to the upside, people are thinking that it's a situation where the tech and the leaders that were the leaders for growth will come back into play. Another area, of course, is the healthcare area. Some of the ones that I've been focused on, like Pfizer. Let's take a look at what Pfizer's doing right now. And Pfizer is up today. And on a down day, that's not a bad sign. $44 a share, make a 3% yield on your money, 11 PE ratio. These are all pretty reasonable numbers. And we're within shouting distance of the 52-week high. So obviously, if it starts breaking above 45.81, which is only a buck and change above where we are today, you'll be in new high territory. And that would not be, obviously, that'd be pretty impressive. And it looks to me like it would like to go up into that area. So keep an eye on Pfizer. It might not be a bad one to keep an eye on. A 3% plus yield is certainly not a bad yield either. Turning towards the one that's really been the big mover, of course, the United Healthcare, and that is been off a little bit today, but look at it gapping up there. So obviously, healthcare and the tech sector are back on the bicycle a bit, pulling back today in some cases, but definitely looks like they're trying to turn to the upside. If you're hopeful for an up move, it seems like the tech sector and the healthcare would be two sectors to keep an eye on right now. I'd like to look at one other area, which is emerging markets. There are those who believe emerging markets will have a good fourth quarter as well if people start jumping back on the stock bandwagon here. So let's take a look at that. Okay, it's pulled back, had a run up here. This is EEM, which is the ETF for it. Looks like it's hit its low at around 37.50, jumped up to 42. So it had a nice big bounce there. Now it's pulling back. So basically, you wouldn't want it to take out the 38 number. And then basically, if it gets above 42 there, you would think it would be pretty constructive. And again, this is a sector that's been beaten up from 52 to 38. So again, a bounce back rally is certainly not out of the picture if things improve. A couple of things I brought to your attention in prior broadcasts is some of the Chinese stocks, because if we get any good news or even looking like we're negotiating in good faith with China, there are some very beaten down stocks here, and I don't think they'd be terrible to keep an eye on. One of them is Alibaba. And Alibaba has this big day coming up on the 11th, which is what? Sunday. And it is, I guess, a very, very big day for them. Singles Day, I think it's called. And so basically, it'll be interesting to see how that company reacts to that. But as you can see, it looks like it might have hit a low at 130. It is rallied above 150, right? And then it's pulling back here to 143 today. So there's a little bit of a gap there, right under 140. Maybe it goes down and fill that, maybe not. And then, of course, if it can break the recent highs above 155, I think that'd be very constructive. And this is things come down from 210. So obviously it's a sold out situation a bit. And now you're trying to find out if this low at 130 will hold up. That's your line in the sand. And then basically you're trying to trade it from the long side using 130 as your get out area. Another one is Baidu. And Baidu is, see how that's looking. That's down again. Again, the low is 177. These are companies to keep an eye on, because if there is a turn in the vibe between China and the U.S. with the tariffs, these are ones that could benefit. Now, these things are very, on the defensive. So by no means do they look like roaring bull markets. But as far as valuation is concerned, the P ratio is only 14 on this, and it has gone from 285 to 180. So you're certainly getting it at a discounted price. Now, if it takes out 180 and falls into the abyss, that's possible. But again, if there is something positive coming out of the end of November, I'd keep an eye on Baba and Baidu as far as two companies that would benefit from a defrosting of the relations of the U.S. and China. Okay, so again, international. Emerging markets and China, keeping an eye on that, and then also looking at the healthcare. And don't forget the area of the tech growers and the growth stocks like MAGA, Microsoft, Apple, Google, and Amazon. Okay, looking one other area that's really gotten hit, which is the oil sector. Oil prices have really gone in the toilet here. They broke under 60, I think, today. And likewise, so has the oil and gas exploration production. So if you are a believer that this is a temporary discount in the price of oil, then this would be something to take a little bit of a look at, because it's gone from $45 down to 34, and it rallied back to 38. Now it's having a pullback. So 34 would be your area that you would not want it to take out. And if it can close above 38, and particularly above the gap there could be you could jump back into the energy sector at that point, and you could be picking it up at a discounted price as well. Again, with the Iran situation in oil and other factors, it'll be very interesting to see. I think this weekend there is some type of a meeting with the OPEC members, probably to discuss what the heck's going on with the dropping price. And if something constructive comes out of there, this might be something to keep a look at. You've got a low at 34, jump to 38, pull back here to 35 and change. Don't take out 34, take out 38. Maybe it's back on the bicycle. Keep an eye on XOP, which is your ETF for oil and gas exploration. Okay, and another one that I've been keeping an eye on, I'm trying to give you different sectors. Some are in favor, some are not in favor. The gold shares. Again, what are we looking at here? We're looking at a higher interest rate environment. What would that be telling you? That'd be telling you that somebody's concerned about inflation. Why would they be concerned about inflation? Because the producer prices just came out, which is basically wholesale prices, and they were up just around 3% year over year. Fed funds is down at 2%. These rates probably are going to be going higher unless there's some big drop in consumer spending, which does not seem like it's in the cards right now. At any rate, the gold has been out of favor for a long time. As you can see, the 52-week low is 17 and change. So keep an eye on these, because if the dollar is to roll over from the 97 area where it is now, and if inflation is going to be picking up and the Fed's going to have to keep hiking interest rates, then the inflation hedges like gold may come back into favor. Certainly, they've not been in favor for a very long time, but that also creates some value down here. So keep an eye on that as a part of a portfolio. And again, if you have a stake in it, if you start seeing, say, the gold here on the miners, the ETF, if it were to start trading above 21 and then above 23, then you might be into something that could be starting into something big. But before you get into something big, sometimes they create a base. And maybe between 17 and 20, this index is trying to create a base of which next year it could build upon. So keep an eye on that. And again, it's not something people are talking about, but let's use our common sense. If the dollar is going to be hitting somewhat of a high because of our deficits and other factors, and if in fact inflation is going to be picking up, like wages are telling us and prices seem to be telling us, then of course it could be a situation where inflation hedges, like gold, could have a better environment in 2019. Keep an eye on that, and we'll see how it pans out. Okay. Let's see what else I wanted to talk to you about. I did want to talk to you about the interest rate market because obviously that's a very big factor. I mean, people are pounding the drum on this Fed, is tightening too much. I mean, Fed funds is around 2%. I mean, let's be frank here. We've got a market here that on the stocks almost hit 30,000 this year. We've seen the prices of assets go through the roof, paper assets going through the roof, right? And so we've had huge asset inflation. And we've had the real estate market come screaming back in many areas quite a bit from the lows of 2012. So we've had prices moving higher. You go to the store, my bill doesn't seem to be getting any lower. You go out to buy things, it costs more, it seems like, than it used to. And again, the producer prices, wholesale prices seem to be going. Next week, you've got some things hitting the fan. The federal budget's going to be coming out on Tuesday. That might not be so pretty. Wednesday, you've got the CPI numbers. So we got wholesale prices up around 3% year over year. And now you're going to get CPI. If the consumer prices are 2.5% or better, that obviously is showing that inflation's picking up a bit as well. Retail sales is on Thursday. So we'll find out what's going on regarding the consumer. And business inventories will be coming out on Friday. Or Thursday as well, but Friday you'll have industrial production and capacity utilization. So a lot of economic numbers coming out next week that'll have effect on things. Again, as I said, once we got above the 3% threshold, the market could see higher interest rates, which is exactly what's occurred. And now it seems to be consolidating between 3 and 3.3. So if we start breaking above 3.3, you'll see 3.5 pretty soon. Again, my view is as long as the S&P is trading above 2,500, the Federal Reserve's likelihood to stay with their gradual increase or normalization process is going to be quite high. Now, normalization process would tell me also that if you get a dramatic jump in stock prices, that might be an opportunity to lighten up your portfolio or to hedge it. We talk about hedging, and like I say, I'm going to give you my email address, OptionProfessor@gmail.com. You can send me an email, and if you have a question on any type of hedging tactic, I'm more than happy to explain the use and the risk of it. But a couple of them off the bat are collars and married puts. Now, the collar strategy, say we got a big run up in the market, you could take advantage of that by selling an out of the money call option, taking the premium in, and using it to buy put insurance while the prices are high. This is a strategy that I was discussing as a potential strategy when Amazon was up at 2050. Selling something, just to use an example, theoretical, say you sell the 2100 call when it's up at 2050, and then you buy the 2000 put. Now you've got a call premium that is paid for in total or in part your put premium, and now you've got insurance at 2,000 on Amazon. It drops down to 1,400 and change. That loss is all offset by your put up at 2,000. And that's the reason people do the collar strategy. It does cap your upside, yes, but you can always roll up that call or do other things to it if, in fact, it does go up. But if it doesn't and it rolls over big time like it did here in the Amazon example, you're looking at a situation where you've offset a tremendous amount of risk in your portfolio. Now, again, that's a very quick explanation and review of it. There is a lot more to really go through fine print, but I would like to invite you, if you do have any questions, to give me an email, which I'll go over at the end of the broadcast. And if you have questions, I can help you with those. Okay. All right. So the interest rate picture, again, we've got a debt explosion here, right? Trillions of dollars in government debt. In fact, the auctions or the refunding was a record in the last auction, and there's lots and lots of supply coming on because deficit spending is at it's going crazy now. Secondly, you've got corporations where you've got leveraged loans and you've got high yield loans where the covenants are very dodgy in some people's opinion. And basically, the leveraged loan market is very crowded as people want to get yield with not much duration. What that adds to is a recipe. If those people ever want to come out, the liquidity of those things is very dodgy as well. So basically, if you have a lot of people coming out of leveraged loans, a lot of people coming out of high yield all at one time, that's how you have an incident in the debt market. And that's where yields could spike up much higher than people think. Is that going to happen? I don't know. Could it happen? Absolutely. Now, with regards to the treasuries, again, they are being supported by the higher prices. Again, with the tariffs, a lot of companies are planning on hiking prices to offset the tariff costs. So, and again, the consumer seems to be still picking it up. So again, that's higher prices for the consumer and also for inflationary numbers. Again, wages seem to be picking up quite a bit. They were like 3% higher. And then basically you're seeing your wholesale prices today coming out, and you'll see your CPI next week. So there's inflationary pressures in the market, and you've got the Fed funds down at a measly 2%. So bottom line is the likelihood that the Fed wants to get that higher than that so they have some room in case they had to ease is obviously a pretty good bet and has been a pretty good bet. But again, anything can happen in the debt markets. But right now, looking for bonds to drop and yields to rise has been the best bet, and it seems like that bet may continue. Okay, anything else going on out there I did want to cover? Basically, I would like to take a look at the gold market. We did cover the gold shares. Just want to get a little idea on GLD. Okay, GLD. Let's take a look at the moving averages real quick because, again, nobody's really talking about this stuff. And I'm looking at a situation where the dollar, which I'll get to in a minute, is at a very high point from the standpoint of where it's been recently. And also the inflationary numbers seem to be picking up. Now, again, this gold seems to have hit a low point at 1111. On the GLD, it's trading 114. Let's take a look at the moving averages and if they tell us anything about a trend change, because really, that would be very interesting. Okay, so I'm going to put up the moving averages here for you, and you could take a look. Okay, we still have a non-friendly divergence here, so it's a little early to ring the gold bull bell because the 200-day moving average is still at 119. And if you notice the chart on the left, that's pretty much where the lows got broke. So that is going to be resistance. That 119, 120 area would be a difficult area for it to get through. If it did get through that, that would be, in my view, very bullish. So I would look at that if you want to really make sure that you've got a little bit of a evidence of a turn. Closing above 120 seems to be the number that I would keep in mind very closely. The volume is picking up, though. 50-day volume, 7.6 million. 200-day volume, only 7.1 million. So the volume clearly has turned to the upside here, and that's not a bad sign considering the last 50 days has been pretty constructive for gold. And that means participation has been coming back in a little bit. Let me just go over here. The sectors. This is Vanguard Materials. And as you can see, the materials had a big bounce, okay? But they have been nailed pretty hard. But it'll be interesting to see if this 112 recent low in October is going to be the low, because look at that. Materials went from 112 in this particular ETF all the way up to 125. That's a heck of a run. You do have some, what do you call it, some gaps there that may come back and get filled. But this is a sector to keep an eye on because it has been waxed so hard from 145 this year all the way down to 112 in October. And it does seem like it has regained a bid. So keep an eye on this because this could be something, if we get into a year-end rally, maybe the prices here would improve. The other one is the I'm going over a few different sectors for you to look at. This is the industrials, okay? Another one that got totally hammered on the downside and now has had a rebound. So now you've gone from 151 this year down to 125 area, right? Bounced all the way back up to like 137. Now you're pulling back a little bit. But again, if we are going to have a year-end rally and the board is going to turn, materials and industrials, which have been way out of favor, could get dragged up with it. And one other one that we like to look at is the banking stocks. That has been a very bad deal for people ever since everyone recommended them back in January. You can see in January, the whole world was jumping into this thing at 30. And since that time, you've never seen 30 again. Now, of course, it's supposed to be a deal with higher interest rates supposed to help the banks, but it is offset if they have to pay more for their deposits and loan demand is not tremendous. It may squeeze their margins and their profits. That's what's been going on. Now, again, similar to materials, similar to industrials, these are three sectors that people believed if the economy was going to get better, that these three sectors would do well, and they haven't. But because they've been sold off so far, all these three sectors, they may be interesting to keep an eye on because they've had a big run up now off the bottom, and now they may have a pullback like they're doing today a little bit. And if they hold the pullbacks, again, they could see if the market overall is going to turn up in the next 6 months. This obviously would be another sector that could benefit as well. So those are three that are out of favor that if we were going to have the whole board turn around, could play a game of catch up. In my view, the growth stocks of the Microsoft, Amazon, Apple, and Google, plus your healthcare, seem to be the front runners if in fact we're going to be turning up, because there does seem to be demographics that is helping the healthcare issues, and of course a lot of the excess in the growth stocks got taken out during that big drop in October. And so a lot of that excess is off the board. Now people are coming in. Don't forget, another thing is we do have the buybacks coming in the picture. That is not a little thing. And this month of November, some people are saying they're looking for a record buyback. So let's see if that, plus the historical after the midterm elections, see if that tailwind can break it to the upside. Again, my view is we're either going to have a very substantial move going into the year end and the beginning of the year, or we could be just entering a trading range where we digest the big drop, which was excessive in October, and then the big snapback rally that has resistance above. Again, the transports, one last thing before I sign off here in a minute or so. One of the last thing to keep an eye on is the transportation average, which led us to the downside. And it is still under pressure now. See, again, it started breaking before the S&P and the Dow. As we broke under 11,500 on the on the transports, boom, it went way down. Right now, it's come back up, but it's still having trouble with its moving averages, which remain at around I think the 200-day. One of them is at around 10,900. So getting back above 11,000 there would be very constructive for the transports. Use that as a pretty good number. If we get above that number, then the bullishness meter will be increasing, I think, significantly. If not, we're going to meander maybe between the lows and 11,000 back and forth for a while. That's door number two as far as I'm seeing it. The other one that led us to the upside and also led us to the downside is the Russell. And there's your Russell index. And the Russell's down 17 today, very similar to transports. You see, just when we got under 1,700 on the Russell, it was sayonara, right? Timber, boom, to the downside. And so again, the moving averages on the Russell come in right above 1,600. So closing above 1,600 will be very constructive. And then there should be resistance at 1,650. So that's really where the resistance on the Russell is right now. If you get above 1,650, obviously that'd be very constructive. But if not, the likelihood of a trading range is increasing, and that's meandering back and forth. Okay. All right. Now, what I'd like to do right now, if I could, is just invite everyone who's listening to send me an email with any question you have on any of the different markets. And if you have any questions on any of the different strategies that are out there, I could maybe walk you through some details and give you some enlightenment on the use and the risk and give you a hand with that as well. The way you contact me is real simple. It's OptionProfessor@gmail.com. That's OptionProfessor @gmail.com. Until next Friday, I wish all of you, as always, all the best of luck in your trading and good health. And again, I will be back with you next Friday on the 16th of November. Until then, have a good week and a good trade.